Weekly stock market update, my friends, and as you can see, wherever I am in the world, I will do this update for you. So let's get right into it, and it's a good one. What do we have? Well, on a price to forward earnings, in other words, you're paying $40 for every dollar of future profits in Amazon, where you're only paying $10 to buy the shares in JP Morgan for every $1 of future profits in JP Morgan. So JP Morgan is green because it's cheap, and energy is cheap. Now that's a very crude measure I've just given you there. It's way too crude. And remember, for those on my Great Investments program, I will be looking at all the factors that we look on there when I speak about these stocks. I won't be just looking at the price charts. It'll be the valuation, the growth, dividend yields of the companies I'm about to show you. There's about 30 odd slides to come. Cash return on capital invested, momentum, because we know that triggers future price movements. So we want to tick the value box. We want to tick the revenue growth box. We want to tick the income box. We need to tick all of these boxes, and statistically we want to make sure that the reward, the average performance, is far greater than the downside risk or volatility of missing it, and that it outperforms the market. So we look at all this. Then we do that across 10,000 stocks, and presto, we've got a portfolio on our hands which can give us 40 to 50% returns on a good year like this by just cherry picking index stocks. Okay, so where are we on this? Performance this week of the market as a whole, everything was green with the exception of tech. Now, some people will say, oh, well, that's tech rotation out. I don't care what they call it. That doesn't matter. What matters is that that's just one way of looking at stock price movements. We'll have to look at the actual company and the fundamentals in a second. Exchange Traded Funds 1 month performance, and I will do a separate video on this. So if you haven't already followed me on alpeshpatel.com/links, do have a look at that. Wait a minute, I've got more slides coming. Do have a look at alpeshpatel.com/links so that, and like and subscribe so that you get kept up to date with these things. Where are we on the NASDAQ? We're up 46% on the NASDAQ year to date. So if you're IFA wealth manager, pension fund manager, your St. James's Place or your Vanguard funds or whatever have not delivered at least the index, whether it's NASDAQ or S&P, 19% for your pension, sack them. That's my considered opinion, because, and don't say, oh, it's just 1 year. Well, that's fine if you like to get beaten up, or if you're too embarrassed to sack them, I'll send you the email you should send them to sack them. So don't be scared, okay, because that's the performance at the moment. And you should be getting, as some of my students are who are NASDAQ heavy, up to 100% return on their pensions because they're NASDAQ heavy, or up to 40% returns this year on, actually more, for those who are looking at the S&P 500, right? Those years happen. They happen time and again. Sadly, they don't happen if you're in the UK and you're sipping ISA and you trust your wealth manager, because they'll get you closer to the index. Actually, they won't even beat the bloody index. Now, none of these, despite being the biggest movers in a month on the S&P, actually made my approved filtered list because they just don't look attractive enough. And similarly with these, despite their big moves. So we're not just going for momentum. We're not chasing the market. We're generally holding for 12 months. What we are doing is looking at 12 months of value, growth, income, cash flow. Okay, all of those factors. Now, S&P 500 have broken that downward trend, moved up, probably moved down before it moves back up again, as it did here. But it's not a negative, because if you look at the monthly MACD, what you see, it is above its own signal line. Now, if you're a student of mine, you'll know what I'm talking about. I don't use this the way the textbooks do, and it's probably likely to move higher. Okay, the FTSE 100 likely to go lower, I'm afraid. Apple, now my Apple strategy is I already hold it, but if you put a gun to my head, I'd buy more, and that's what I'm going to call the Apple strategy for now, because the monthly MACD is above its signal line and flat to rising, so that's enough for me, and it's not too overbought. So we're going to adopt the Apple strategy, and if you want to look at all of these, remember, have a look at alpeshpatel.com/links if you need to understand more. Okay, so that's your Apple strategy. I've got some colleagues coming on a helicopter in a second, just above me, so excuse the news if you hear the noise, if you hear the helicopter just about to land. Alphabet is also Apple strategy, because for the same reasons, that is fairly flat, likely to rise a bit, and I still don't see that as being negative. What I see negative is if the MACD is moving downwards, and certainly if it's below its own signal line, which is what happened here, and that's what told us to get out in February of Alphabet last year and save all of this, whereas your fund managers can't do that. Your fund managers can't go into cash, they're not allowed. right? Whereas we can. That's why my program's far more better than any rubbish fund manager, all right? So that's Alphabet. Microsoft, very much the Apple strategy again. In other words, again, just to repeat the Apple strategy, that is flat to rising, it's not overbought, and it's above its own signal line. There's a lot I've said there. Okay, and we've looked at the fundamentals: value, growth, income, cash flow, Sortino, alpha. And it's a nice little touch that all the banks, major banks, agree with us, and seasonality-wise, it doesn't look too bad. So Microsoft would buy more, even more, right now, although I hold it. So we'll call that the Apple-Microsoft strategy, ironically. And then we go with that. Similar story, why I think that is flat to rising, not overbought, and so bullish, and it's above its own signal line. If it were to fall below it, as it did there, you can very much expect that kind of a fall, and that's not happened yet. Similarly, if it was going sideways or just kissing it or just around there, it'd be doing that, and it's not doing that. It's more in this kind of a territory. There's only three types of territories, okay? Up, sideways, or down. And you can pretty much get a better, cleaner look by looking at the monthly MACD on those. And at the moment, this is still part of the up. Now, it might transition to sideways, but it certainly hasn't done that at the moment. All right, very informative. Thank you very much. You're welcome. Disney was a special situation for us. We're expecting it to go from there to up there, as it did in the past. So it's high risk, special situation, which means it's not quite on the approved filter list. More stocks to come, but it's not quite on the approved filtered list for maybe volatility reasons or valuation or growth reasons. It doesn't tick all our boxes, but it's sufficiently worth looking at. And so I put it under a special situation, which necessarily means it's higher risk, okay? And that's your Disney, and that's what the analysts on average think with Disney. Nvidia, now you've got to know the Nvidia strategy, which is this. That's the high. If it drops X percent, and you can decide what X is, whether it's 10, 20, 30, 40, then you will sell Y percent. And Y is a number you decide based on your risk appetite, okay? Because you can't see into the future, and it's overbought. It's not quite sold off yet. It's still sideways, but it's overbought. So there's a bit of negativity here. It's overbought. In other words, it's in the top half of this graph. And my worry is it starts doing this and then falls off, as it rose and rose and rose in the past and then drops off, and it could do that. So you might say if it drops 10%, you'll sell 20%. Drop 20%, you'll sell a further 40%, and so on. You can pick those numbers based on your risk appetite. You might say, no, I want to hold it forever. Well, that's up to you. But what you don't want to happen, which is what the fund managers did, is, oh, no, we're going to hold this forever. And they see that ride up and you think, oh, they're very good. I'll buy that fund manager. And just as you get into the fund manager, because they can't go into cash and it falls, they make a massive loss for you of 50%. And you go, oh, no, I've just lost 50% with the fund manager. And then the next year, it goes back to break even. And you go, oh, well, great. It's taken me over a year to just come back to where I was. Whereas if you'd gone into cash and listened to what I said and watched, and we're not trading our investments, then you wouldn't have had that problem, would you? And there's not a lot to ask to watch these weekly broadcasts on Telegram or YouTube. Just watch alpeshpatel.com/links and you'll see it. Now, I got out of Tesla when it fell below the upward trend. So that's when I got out of it. But I'm keeping an eye on it for you because it'll be one which we might get into in the future. And it was a special situation we got into January. So again, if you're on the Great Investments Program, you'll know all this from the private Telegram channel. We got in January and we've had a great run and a great return, but I got out of it because I wanted to ease back some equity positions, and it's still got some room to do that, but we're not in it at the moment. Might get back in as another special situation again. And why is it a special situation, not on the approved filtered list? The volatility is just too high for it to meet all our criteria. Okay, and similarly with Meta, you've got the Nvidia strategy here. It's overbought, so just be careful it doesn't start doing this, where it's got a bit more to go. It might have a bit more to go, by the way, and then it just can drop. So that's why we're keeping a weekly eye on it. It's why I do these broadcasts every week. You can't just say, I'll buy it and hold it forever, because guess what would happen? It's a stupid thing when people say, oh, I'll buy and hold forever, because let's say you got in here and said, oh, I'll just buy and hold forever. Great, you made a great return, but you could have avoided this massive fall. Could have avoided that massive fall so that when you had this gain, you had a wonderful gain. Instead, what happened? You had about 2 years of nothing, whereas anybody else would have avoided falling 80%, and then they could have captured a bit of this 250% rise, maybe just 200%. You happy with 200%? Of course you are. And you certainly don't want an 80% drop, okay? And that's time. Time is money. So that's why we don't just buy and hold forever. We keep a weekly eye on it, and that's what my broadcasts do for you each week. They save you a lot of time, energy, and effort. Now, this is one I own. Apple strategy with this as well for the same reasons. MACD above the yellow signal line and moving sideways to upwards and not overbought. So looking for, and of course we looked at value, growth, income, cash flow, and with our 12 months are not up, which is the period we hold these things for. Again, if that's confusing to you, have a look at alpeshpatel.com/links and I'll explain more stuff there. Costco fell off a cliff. We'll see if it's going to do this or this. So it's a bit of a wait and hold, just proves that everything I touch doesn't necessarily turn to gold. It could do that or it could rise. It's too early to tell. So we'll keep an eye on it. It's a good, solid company overall. Netflix is not one I own, but the reason it's on here is for the simple reason that it's very popular with people, so I thought I'd show it. It's good educational material there. We're still at the up stage. We're not at the side stage, and we're not at the down stage on it, okay? So it looks like we're still on the up stage. There'll come a point where we've got sideways, and then we'll go down. All right, so that looks good. Now, would I buy more of it now? Okay. Because that's what I've said is when we started the projection of 70%, and there's still a long way to go between here and 70%. So yeah, I might. But I don't, because there's only so much I can buy. Please have a look at alpeshpatel.com/links. Look at my campaign for 1 million, especially if you are with one of those terrible IFAs and wealth managers who I say time and again, they can't go into cash, so they miss that. They can't invest across the whole universe of stocks because they can only give you a few funds which invest in a narrow geography or style. So they miss going through 10,000 companies. They can't monitor it every week because it's not their job. Why should they bother? And if you get in after they've had a big rise, like say in a Meta, to give you the example, and Meta's about to drop 80%, they can't get into cash on it anyway because they can't go into cash, and they'll just watch it slide. And you will have got in at the top, whereas you could make that individual decision yourself if you know what to do. So that's the whole point why the campaign for 1 million exists. Thank you all very much. As I said, do like and follow for more.